Gila came out last night. Hello, everyone! Welcome back to the RationalInvestor.com's Weekend Frivolity! This is the Broiler Chicken Show. The RationalInvestor.com's Weekend
As I was sort of joking with the people that are in the hangout
this
here
is the Broiler Chicken
on
Show
the site right at the moment. Happy belated. Actually, I'm not even sure exactly what date it is, but one of TRI site OGs had a birthday party overnight, so a couple of us local people here in Vancouver were at his place. And the girls were dad-bodding Brian all over the place. Jesus, make me feel insecure. I can't even go out in public now. Anyway, good morning, everybody. Welcome to the frivolity. I suppose the last thing you care about is dad bod references. But you know, if you hear it in my voice this morning, it was a fun evening. Let's put it at that. Happy birthday, Shane, and had lots of fun with you. And one of the guys actually was at the party last night. Andrew, local OG here, he actually was telling me last night he hit that 61.8 fib on Bitcoin, and he's just feeling like a trading god. And if I'm not mistaken, I think I even saw him just a few minutes ago posting in the lounge. Nice wins booked on what was that, ONT, NEO. So I don't know what this trade, and you know, this is just what we do at TRI. We're just talking setups, and you know, just 24/7. It's constantly coming. But Andrew here, and I love this. We used to have the posters all the time. Winner, winner, chicken dinner. God, we haven't talked a lot of that kind of talk in altcoin land for a heck of a long time, eh? But you know, here's just a perfect example of a very typical trade setup. Hopefully everybody looks at this and goes, okay, well, I can see signs that, you know, internally the market is stronger than what price would lead you to believe, what we call our divergence concept. I don't know whether this is my overbought, oversold indicator here on Andrew's chart, but kind of looks very Willy-ish, stupidly oversold, all that kind of talk. And I'm getting the impression this is a pretty good volume indication. Volumes ramping up. Hopefully everybody can see the pretty well-defined W's that are on Andrew's chart, and he had a nice little target of a 50% tag level, and it looks like Andrew just got paid this morning. Way to go, dude. And it just goes to show, I mean, I'm not here to reinvent the wheel. These concepts are actually pretty old and they're pretty universal. Try and find some sort of location, you know. I mean, I suppose we can talk. Actually, the level oneers were just doing location today. Of course, you know, we can't teach everything in the education program all at once. So the first big location tool I like to teach people that are sort of new to trading is the Fibonacci retracement tool. And you know, we spend a full week working on the tool to make sure that students are using it correctly, and we have a really you know, the level one program. I gotta say, I absolutely love our level one instructor right now, Grim. Just absolutely fantastic job. So he spent lots and lots of time going through their questions this morning. But just an FYI for you guys, a while ago I actually did up, and this is the level one room. There's Grim, the instructor, rocking it. So this was our session this morning. And I just about 6 months ago, 8 months ago, and this is probably good information for the YouTubers. I actually created a couple sort of what I like to call pocket tutorials. They're just sort of quick 10-minute tutorials on how to use fibs, both for retracements. You can see, I don't know how long this is, 11 minutes. And then also for extensions. I like to think of this, for me and what I would consider like beginners to trading. I think this is an excellent starting point for location tools. That's what the level oneers, and I'll just throw these links in the YouTube Hangout lounge there. They're fabulous little, just sort of, quick little 10-15 minute summaries on how to use these tools. As I said, the level oneers, and really, I hope everybody on the YouTube page understands and just be empathetic and stuff. I want to make sure that the level oneers feel as though, whoa, man, did I ever get good value for the money that I spent in this course. So not only they just had a 2 to 3 hour session with the Griminator, along with all the pre-recorded lectures and stuff that come along with the course. But what I like to do with this is I actually like to dovetail this so that if they have any lingering questions, maybe they're not topic specific. We had one question coming out of the class this morning, which I'll speak on in a moment, but really this is their opportunity if they had any lingering questions, and then I'll just I'll drop tidbits and nuggets for the YouTube audience, like these little pocket tuts that I have available. This is basically right down that alley. So in essence, try and find trade location. And those fib tools are really handy. Reload zones, all that kind of concept. I suppose you could even argue that there are probably like little reload zones in here to sneak in really cheaply. But then your second step of that 3-step process is we want to try and find signs of internal strength. And I suppose for you level oneers, you're going to be doing this in earnest in 2 weeks. We have to get through candlesticks, so we're going to be talking candlesticks next week. But next step, and you guys, when in your introduction to technical analysis module, you should have, we introduced you to indicator information and a very brief introduction to RSI. And I think actually we even have a Coinigy tutorial for RSI. But when we get to indicator confirmation and divergence, you'll understand this stuff. And then, of course, do we have any W's? Can I see a W? And hopefully when you look at this chart, you go, okay, I see a higher low, higher low, higher low, higher highs. Nice breakout here. Just fantastic structure. We like to, level oneers, we really like to use the 50% rule. And gee whiz, we sure have talked a lot about that, about Bitcoin recently, as a profit-taking objective. And this is just absolute textbook. And the one thing I love about Andrew is, I gotta say, it's like some people, I sort of, I impart the message and it takes them a very, very long time to come full circle back to the original message of, buy W's, take profits at 50% rules, if the W's broken, walk away. And this guy, he just bought the message from day one and he's just a machine. And that's, the sad thing is, you want to be good at trading, that's what you got to do. You got to be a machine. In fact, my old bot setup I used to talk about, I used to say, when I turned myself into a robot, I traded like a machine. And that's, to be good at trading, that's what you got to do. You got to be just incredibly methodical and precise and And look at this wick here, right into that 50% level, and then it backed right off. His sell order was probably what stopped that bull market. Way to go, Andrew. You just pissed off a whole bunch of crypto kids. And they're all posting comments here in the Hangout here. So anyway. Never a dull moment in the market, that's for sure. And it's kind of funny that I started off on this tangent because, of course, Bitcoin's gone absolutely bananas here as of late, and that's probably what our primary focus should be here. But before we get into that, like I said earlier, a big part of the reason why I do these Sunday shows is I would just simply want to dovetail with the level 1 program. And one of the questions that I saw, and of course, if there are, we got about a dozen people or so in the Hangout here, and I see there's a good chunk of people over there on YouTube. So if there are any level 1ers that are on the call, hello, Southern California. Hey, I used to live in Palos Verdes, Omar. Do you know where that is? So right around the corner. And Omar, you should give a shout out to Joshua. He's in your neighborhood, and he's got one of those Teslas, so he doesn't even really think about driving 2-3 hours at a time. It's no big deal to him. So actually, Joshua, are you in the Hangout here this morning? I thought I saw you. Hey, power naps. Yeah. So there's a bunch of us, and of course, Omar, if you're familiar with the Riviera brothers, oh my goodness, Daniel's another one of these type of people, and I've given him shout outs. In fact, actually, it was actually just about exactly 1 year ago. It was back in December of last year. Andrew, Reza, and I all shared with Kevin, the Kavarkanator, who's the Duke of Albuquerque, who runs the shows for me, the Daily Briefs. We all crashed in a place in right around the corner from USC, and if you know Southern California, that's an interesting neighborhood. Last year, and so Omar, if you can, reach out to the Rivieras. They're up in Ventura. And Daniel and Oscar, they're great guys, just absolutely fabulous people. So we actually have a really cool little community down there in Southern California. But anyway, moving on. If you as Andrea says, smash the like button. Appreciate that. Oh, I already got one downvote. I haven't even said anything here today, and I already got a downvote. Oh, goodness. Crazy life. Oh, well, silly YouTube. I mean, I don't really understand how you can even vet these likes and dislikes and comments and stuff. I mean, do as you please. If you like the video, if you happen to have gotten some value out of this information, awesome. If not, I mean, I guess it's a free Google world. Oh, look at that. There's a second downvote. I haven't even said anything, and I'm already getting downvoted. Oh, it's hilarious. Oh, it's so screwy. Oh, well. Okay, so, as I said, if there's any of the level 1ers on the YouTube page, or if you're in the lounge, the problem is, guys, if you are in the Hangout here, probably best, and I've got like 20 different screens going here. I mean, you can post the question here in the lounge, in this little Hangout here. I see those guys are all getting, they're posting jokes. But if there are any level 1ers, you can even post in the lounge on the site, and I'll try and answer your question. But there was, and I'm stalling here. Keep in mind, everybody, I was out drinking tequila last night with Shane, so I'm actually feeling a bit sensitive here today. So I don't know whether I'm going to do a good job or not. Well, let's have some fun. Okay, so to work. Well, there was one question in particular coming out of the level 1 class today. And somebody had asked, I don't understand what the hell Brian's thinking when he talks about risk on versus risk off. What's a risk on asset? What's a risk off asset, etc. So, in simplest terms, probably the easiest way to think about this is to get rid of all these ancillaries and just talk about, in this. Let's see if I can do this. I might have to refresh this. Give me a second. While this refreshes, I'll talk. Well, actually, that was pretty quick. Okay, is this gonna work now? Boom. No, that's not what I wanted. So there we go. In simplest terms, I think you could make the argument that for the market, if you think about just pure what is a guaranteed asset and what is not, the easiest way to think about this is government bonds, their principal is guaranteed. Now, this isn't a comment about, sustainability of Western civilization and, 1% diluting the purchasing power and standard of living of society, and, are these governments going to default from their debts, and, what's the implication of zero interest rates? Remember, zero interest rates, that has nothing to do with the price of the bond. That has everything to do with the coupon that's attached to the bond, the sweetener to sort of offset the effects of deflation or inflation. I'm just talking about principal, right? When you go and buy a bond, technically you go and lend somebody some money. And the idea is that it's a loan, and you will be given that money back at some date in the future. And when it comes to sort of like the way our society is built and the legal system, people that are owed money through things like bonds and loans, they have a different status in, say, something like bankruptcy court. They are sort of at the front of the line. If a company or an entity is dissolved, the bondholders get claim on anything first. On the exact opposite end of sort of the risk spectrum is this concept called equity. Equity has no value. It has no intrinsic value. It's in essence a proxy on whatever's sort of left over on the company's balance sheet, following sort of all obligations to be paid off to debt holders and other various stakeholders of an entity. Primarily, equity is a concept used in valuing things like companies. But you can make the argument you can have equity in real estate, the amount of money that when you go and buy a house, you put 10%, 20% down. You borrow the rest, through a mortgage. And as you pay off the mortgage, some of those payments go towards the principal of that loan. And you're building equity. You can have a life insurance policy where, if it's a whole life policy, it actually has an equity component where part of those monthly payments goes towards like a savings plan where you're just building up asset, wealth in the policy. And the point being that equity expressed in the stock market is really it's a function of a company's earning streams and what is the perceived sort of earnings stream growth rate going forward. So a lot of companies carry debt, so the debt, and companies issue bonds, right, those loans, they're and the ability of the company to service that debt is taken into equation, and in essence, if not only the equity in the company itself, sort of assets minus liabilities, is positive, but also the perception that that trend is going to continue more positive down the road, i.e., growth. Equity doesn't necessarily have to have a set valuation. There can be almost like a perception or a perceived value of that equity. And in the marketplace, they often talk about that as like the PE ratio, or the price of the asset relative to its earnings that the company is actually making. And, if a company isn't making any money, they won't have a PE ratio. If a company is consistently making money and consistently growing, then quite often the market will actually add a premium to that consistency, to that growth rate. So PE ratios can be negative, they can be single digits, they can be double digits, they can be horrendous numbers, because the market perceives that the growth of the company is going to be very, very strong. But nothing's written in stone. And PE ratios zoom all over the place. But the very simple idea is that because there is no guarantee to equity's value, if the company doesn't earn any money, and let's say they have a whole bunch of debt, they might actually go into bankruptcy. They might become insolvent. There's no guarantee to your principal. And quite often in the marketplace, equities trade at actually pretty rich premiums to those earnings streams. And quite often what happens in a crash scenario is those price to equity ratios get bid up to just ridiculous levels. .com days, I mean, God, we were trading at like 40 times earnings on the S&Ps. And the perception is that the economy will just keep growing indefinitely. And then, the usually what ends up happening is the people that loan the money come out and say collectively, we think growth is a little too strong here. We need to slow things down. And they actually start increasing the cost of borrowing money on the short end of the curve. That's the whole concept of the Federal Reserve, and in the States and in various countries around the world, they call them the central banks. So if you can approach this concept from just simply what's a guaranteed investment, you absolutely know you're going to get your principal back, and what is a risk asset, we are just simply betting on growth going forward, then understanding how stocks are risk on, in essence. All right, we feel like we're gonna take some risk here. Right? We think the market is growing. Let's get in there and let's buy up growth. Versus risk off. Oh my God, the economy is contracting. There's bankruptcies, defaults. Maybe my equity might actually go into bankruptcy and be worthless. I better go buy something that's government guaranteed. At least I get my principal back at the end of all this. And as a sweetener to offset the effects of inflation, they're going to pay me an interest payment along the way. I think we can make a clear argument. This is completely aside, but just to sort of clarify why banks and why there is this sort of trend towards what they call negative interest rates in the short term. And that's simply because what kind of world are we living in? Are we living in an inflationary world or a deflationary world? And this is a really hard concept for most of us, including myself, to sort of grapple with, because it's the selective measures of inflation. Like when I go to the grocery store, I mean, gee whiz, even just the price of a loaf of bread now is like $3 or $4. I mean, it's just ridiculous. But in the market's eyes, and I like to use market-based proxies to tell me whether we are in inflationary markets or deflationary markets. And what I mean by market-based is the tips are basically a product that was brought out in the 1970s and 1980s because the inflation rate was just absolutely horrendous. Double digits, all that kind of stuff. Interest rates were through the roof. So the tips were one way that investors could still, I can imagine, Zach says Hawaiian prices are a little bit higher. But the tips are, like we said, with that whole inflation fear in the 1970s and 1980s, the market was spooked, and so one response was the U.S. government said, look, we still need to borrow money. We understand that there's an inflation worry in the marketplace, so here, we'll make a compromise. You lend us the money, bonds, right, loans, U.S. treasuries, all that. We live in the world where the U.S. has to keep borrowing money. We will include an inflation index component payment on these tips and treasury inflation protected notes, right? Tips. And so if the sort of headline inflation number is positive and rising, then you'll get an added payment on your bond holding to offset that inflation effect. So this is and then the TLTs, that's the bond ETF, U.S. Treasury bond ETF, and it does not have that inflation component. So you have to sort of take the step, the conversation one step further, and you have to think, okay, so what's an investor likely to do if they see that the inflation rate is low and they're not going to get that inflation payment from the tips because the inflation rate's really low? Are they going to pay up? Are they going to associate a premium to those tips? And then conversely, if the inflation numbers are so low and they might actually print negative, are investors may be going to discount those tips? You're not going to get any payment for having that inflation protection, so why pay up for that inflation protection? So in a weird sort of way, I like this kind of market sentiment proxy because it just simply tells me, are investors themselves voting with their pocketbook, with the dollars in their pockets, are they willing, do they want to pay up for that inflation protection? And as you can see, the relationship is clearly in the direction of the TLTs. And when this number is negative, i.e. the TLTs are trading at a premium to the tips, it means that the market does not see the need for that inflation protection. In fact, the market actually thinks that we're probably in deflation. And this has been a really handy tool. Now, I'm not quite sure with TradingView why it only goes back here, but this has been a really, really handy tool to just sort of keep an eye on whether inflation or deflation is coming back into the system. And it's interesting because we had postulated for quite some time that maybe this was an inverted head and shoulders and we were going to start the process of building inflation back into the pipeline. I think the Fed saw this and said, okay, well, we can start now, quote unquote, normalizing interest rates. So the U.S. Federal Reserve takes their interest rates off of absolutely, historically ridiculously low levels, and tries to sort of normalize interest rates. And the market just said, too fast. There ain't no inflation here. You just killed the economy. Thank you very much, central bankers. Way to go. And, to a certain degree, this is almost like Donald Trump's mantra here. You've raised short-term interest rates too far. You're killing the economy. You got to take those goddamn short-term interest rates back down. And, to a certain degree, I think the guy's right. We are very comfortably back into deflation. And I wouldn't be surprised if the Fed actually has to do some backtracking here. The weird thing about this cycle, of course, and total off topic, but the weird thing about this cycle is, the last cycle, Volcker, in his war on inflation, took interest rates to double digits. So everybody sort of has that in their mind. Okay, high interest rates are double digits. But in a weird sort of world, or in a weird sort of way, if everybody else is like negative interest rates and the U.S. takes their short-term interest rates to 2-3%, in a weird sort of way, that's almost the same thing, relatively speaking. And the other side of all this, of course, is what we're seeing in the market right now. This is more a comment about that sort of negative interest rate, but it has nothing to do, and this is the important thing, it has nothing to do with this risk-on, risk-off conversation. The risk-on, risk-off conversation is all about guarantee of principal. And, when we're in here buying like cryptocurrencies and throwing like $500, $1,000, maybe, I don't know, 5-10 grand, whatever, that's risk capital. But if you're dealing with like state treasuries of like, $100 million or $1 billion or something, can you go and risk, like losing 50% of the value of that kind of asset, especially if you're like dealing with pension funds and stuff like that? The answer simply is no. And, it's kind of funny. This was an absolute rule when I was in the business, and now that's like 4 or 5 years ago. It's been that long since I've been sort of in the professional trading business. But it's fun to watch YouTube videos and stuff like that. But they often say that, at prop firms and institutional trading desks and stuff like that, your job isn't to make money. Your job is not to lose money. Because keep in mind, it is extremely easy to lose money in the stock market. So, if you're dealing with professional money managers who their number one job is not to lose money, then, this understanding what kind of sentiment we're in here, and trust me, and go back and look in 2007, 2008, go back and look to 2001, 2002. You look at what risk assets do when the economy does go into recession. It can get pretty damn ugly in equity land. So hopefully that helps. First and foremost, we start the conversation of risk on, risk off with just this idea of principal is guaranteed, equity is not. Bonds, the principal is guaranteed. Equity, there is no guarantee to principal. So it's just that simple. Then if we take it one step further, what I have found, and this is, just my personal experience, if we do something like the commodities, what I've found is that, and this is an interesting situation right at the moment because we have both oil and gold going up at the same time. What I found in my history in the markets is that, yes, gold and oil are both commodities. And we can sometimes get into windows where all of the commodity prices are rising, and they call that, and if the stock market itself is not rising, they call that stagflation. But usually what ends up happening is oil and gold are actually at the opposite ends of the commodity spectrum. In that, and I distinctly remember this in 2000, the last greed cycle pivot, when we went back into the commodity cycle, the oil took off right away, just right out of the gate. It started to move up first. And the interesting tell that I remember through that was in early 2000, 2001, 9/11 and all that kind of stuff, but that was a cycle top, and the market had been working its way lower prior to 9/11. But the first news that came out that sort of caught my attention that, okay, we are now into the fear cycle, commodity prices should start rising, was the airlines repeatedly through the late 1990s kept trying to raise prices. And they just couldn't. They would raise prices, and then the market balked. And somebody else like Southwest usually would come along, price competition, and the prices would go back down. But in early 2000, with energy prices starting to rise, the airlines just simply said, look, we don't have any choice. The prices have to go. And at that point, when they raised prices, they stuck. And everybody went, okay, that's fine. Yep, the prices got to go up. And nobody else could undermine them because it was a function of rising energy prices. And that sort of, I remember distinctly in early 2000s, that sort of kicked everything off. And then once that sort of beast was unleashed, and of course, through 2000 to 2008, that was basically the oil bull market. That was the front end of the commodity cycle. Energy prices were leading. And in the inflation game, they use two terms. They say, what part of the inflation cycle are you on? Are you in the cost push part of the cycle or demand pull part of the cycle? So what usually ends up happening is and keep in mind, workers always come last, right? The employment data is always the lagging indicator in the economy. Usually the employment situation hits its zenith right at the very end of the cycle. Interesting that basically employment is at historic lows right now. Unemployment, that is. So, that sort of is corresponding with what we're seeing. But usually what ends up happening is the underlying raw commodity prices rise and energy is the leading component. That translates into the balance sheet. Costs are going up. Companies have to raise prices. Society generally, you go to the gas station, you fill up your car, and it costs more money. Go to the grocery store, food costs more. Pay your heating bill, that costs more. Eventually, workers start saying, hey, we need more money because we're not surviving. And then we transition into the demand pull. And that's basically all the workers demanding higher wages. And actually it was really interesting. I was even... like I said, I was at a party last night, and one guy there was like, oh, yeah, we're on strike right now. I've been on strike for 45 days. I remember like 5-10 years ago, God, you couldn't go on strike. I mean, you'd be fired in an instant. Like, trade unions didn't have any power at all. And so now I'm starting to hear people are going on strike. GM's on strike right now. So the workers are finally, this is their part of the cycle, the demand pull. And so in essence, crude oil prices are just a pure proxy on that cost push, the front end of the commodity cycle. And gold prices, as the ultimate inflation proxy, they are a great proxy on the demand the demand pull part of the equation. Cost push, demand pull. So what I've often seen in my career is very rarely do you have a situation where oil, which is the front part of the cycle, and gold, which is the back part of the cycle, move and the same. Usually it's actually the opposite. And also remember, too, that if investors are buying gold and gold-related assets, what are they saying about growth? Do they want to put their money into things like tech stocks and high valuation equities? Or are they going to go take their money and just put it into a lump of metal that just sits on the ground and doesn't grow? So in itself, if investors are actually considering buying gold, that means they're not really that excited. And if anything, they're getting worried about the purchasing power of their money, so they're taking their money out of money and putting it into hard assets like gold. What I've also noticed too, and this has just been an interesting observation on my career, is the Japanese yen, to a certain degree, has now become sort of like the if I don't have confidence in the euro, and it's very difficult to have confidence in that region, unfortunately, the euro, I think, is a classic sort of example of socialism and how socialism can really it creates incredible imbalances. Like I think the Germans love this euro concept because it's kept sort of the German currency very low. And of course, they're very industrious. They're less socialist than, say, some of the southern European countries. The southern European countries are, very, very sort of. I don't know whether socialism is the right word. I mean, it's borderline corruption, but much less efficient, let's say that, than the Germans. And so as a result, there's lots of slippages in the euro, and so the euro currency is extremely weak because the eurozone just isn't growing because the economies are incredibly inefficient. But euro aside, it's my belief that the United States of America's currency, let's say, coming out of the First World War into the Second World War, interestingly enough, at that point, like one of the main reasons why the Second World War happened was because of the Japanese situation, and how the Americans basically said, sorry, we're withholding all your oil. So, at that time, United States, and of course, through the Second World War and the history of that, became sort of like the net creditor nation. And, heading in through the Cold War and stuff like that, and Bretton Woods and all that, basically became sort of the foundation for our modern fiat world we live in. The transition through the Ronald Reagan presidency into this world where we live in deficit spending now means that the United States of America has no choice. It has to grow. And if the United States of America doesn't grow, then things like quantitative easing will have to happen. And in essence, that's the same sort of thing that's kind of going on in Europe as well. Just to sort of maintain, and unfortunately, what that does is it just dilutes the the standard of living of everybody. Whereas, and I mean, you can make the argument Japan's the same sort of way, but because the Japanese, they own their own debt. I don't think there's ever an issue that there's going to be a run on the Japanese currency because all the bondholders are Japanese. Versus the United States of America, one could argue that quantitative easing was nothing more than taking all that bad debt that was floating out in the market and just transferring it back over to the U.S. banks' balance sheets. And I've been thinking about this for a while. In essence, the last fear cycle ended, technically 1981, 82 kind of idea. And this might be an interesting quiz question. Was there a financial crisis in the real estate industry in the early 1980s? I wonder if any of you even remember this. Because there was, and it was just as big as all this quantitative easing nonsense you hear now. No, I'm talking about the United States of America in particular. And the interesting thing is I lived in Southern California through this, so I remember it intimately. No, not junk bonds. But you remember Michael Milken? He was the junk bond king. But no, not that. That's not the reference I'm making. How about you guys over on YouTube? 53 people watching. Does anybody remember what the real estate crisis was in the early 1980s that was almost exactly a carbon copy of what we are actually seeing happening now? It's just obviously on a much smaller scale. The numbers are different. This is more global in nature than it was primarily in the United States, internally contained. Nobody? Nobody? Anyway, oh, that's too bad. So it just goes to show, if we don't learn from history, we're darn, and this is kind of sort of your, sorry everybody on YouTube that's like, I thought he was going to talk about Bitcoin today. That's shocking that nobody knows the answer. Not even anybody here in the lounge. Nope, nobody knows. Let's see. I don't want to give you the answer. What the hell was that guy's name? I can still remember him. He's a thin, tall guy. Just a little bit of hair on the top of his head. An old guy. Yeah, nobody can remember. No. Anyway, I'll give you a hint. I'm not going to tell you the answer, but I'll give you a hint. The hint is Bailey. No, that's it. How about Bedford Falls? That might be a little bit easier of a hint. If you can connect the dots with Bedford Falls, what does Bedford Falls and the Baileys? Yeah, that's two pretty good hints. Everybody should know this. We're coming up. There you go. Colleen got it. Okay, so what's the connection? What's the connection? Okay. What did Mr. Bailey run? Does anybody remember what business they were in? Anybody over on YouTube? So Colleen here in the lounge got it. The reference was to It's a Wonderful Life. So the question is, what business were the Baileys in? It's shocking that nobody here. Look at you guys over on YouTube. 58 people sitting there, not total crickets. That is incredible. I mean, guys, you got to learn this stuff. No? All right. So everybody's like quickly, hey, somebody got it. Teresa, you're a level 1er, right? All right. What's an SNL? Does anybody know what an SNL is? And how times have changed. I mean, SNLs used to be like literally the backbone of the mortgage industry. Anybody remember the SNL crisis? So, where am I going with all this? You can make an argument that exactly the same thing happened in the late 1970s as happened through, Fannie Mae and Freddie Mac and all that. And what was interesting was in the early 1980s, there was a U.S. government-sanctioned body that was created to deal with the SNL crisis. And what did they do? They simply went into the marketplace and they bought up all the bad loans and they put them on this special balance sheet that was totally separate from everything else. Does this sound kind of familiar? Doesn't this almost sound... It almost sounds like history's repeating itself. The point here is we've actually done all this before. And I was thinking about this over the weekend. I was actually a little surprised. And so I was playing Connect the Dots. And I was like, gee whiz, this sounds awfully familiar. So if you want a good history of how these fear cycles play out and what governments have to do to try and deal with all the bad debt that happens in housing bubbles and stuff, actually... This whole quantitative easing and the Federal Reserve balance sheet, it's just another incantation. Like in the Great Depression, Roosevelt created a body called the Tennessee Valley Loan Authority, I think it was called. TSBA, Tennessee Valley Loan Authority. Anyways, extremely famous. And of course, and all the right-wing people and, people that, want to preserve the purchasing power of money, hard money theorists and stuff, they called it outright socialism because basically the U.S. government could just go buy up massive whacks of bad mortgages and basically take possession of the land and socialize the losses. So we do this every cycle. It's not like this is brand new. That's the irony of all of this. This go around, they're calling it quantitative easing. Oh, what a joke. But what it really means is just simply they're taking, and the important thing to remember here is it's not going to help the people that borrowed the money to begin with. They've been forced into bankruptcy. There's no empathy for them. All this is about is protecting the people that loan the money to begin with, the banks. And interestingly enough, like the Japanese have talked lots about how, through their demographic cycle peak in the late 80s and early 90s, how the banks just carried all this bad debt on their balance sheets going forward, and it was one of the reasons why the economy is sort of stagnating. Well, this is the American solution, is let's not force the banks to actually carry the bad loans on their balance sheet. Let's create these sort of third body parties. I remember when Mexico blew up there in the 1990s, they created a sort of third party body to sort of soak up all the bad debt out of that. So it's actually par for the course, what I'm trying to make reference to here. But the point that I'm full circle, sorry I'm wasting everybody's time, but I'm having fun here this morning, so what the hell. The point that I would just make is that the Japanese yen, because the bonds are owned by the Japanese people, it means that they're not as suspect, or they're not, what's the word I'm looking for? They're not as susceptible to broader market forces. Like I said, I think quantitative easing was simply the Chinese said, look, we got all these bad Fannie Mae, Freddie Mac, mortgage-backed securities that Goldman Sachs rammed down our throat. We got all these bad bonds on our books. You better take them off our books at face value, or we're just going to dump them into the marketplace and bye-bye USA. And so I remember Ben Bernanke when he was speaking in front of Congress when he started QE. Man, that was one scared-looking guy. And so I think that, and that's a historic testimony. We should keep that on reference, because you could literally see the fear in his face. Is the American public going to buy this? Are any of these senators going to say something to totally derail this? We got to pull this off or we're screwed. And he pulled it off. So, one might argue now with all these bad bonds over on the balance sheet of the Federal Reserve that they sort of hit the reset button and away we go. But if growth, and if there are more creditors out there, maybe the Chinese got a whole bunch more bad bonds that they're ready to dump on the market. Who knows? Maybe it's the Russians. Maybe it's the Canadians. The Canadians are buying all these damn U.S. bonds up. Let's hit the bid, right? Who knows? But the point is that the United States is susceptible. This is the way they built their system. They like open free markets where anybody can own the paper. So as a result, if growth prospects are in question, whose paper is going to get run on the hardest? If growth is humming along and everything's tickety-boo, then you bet on Uncle Sam, because they've leveraged their future on growth. If, however, that growth comes into question, where are you going to run? We've talked lots about the U.S. dollar index, and people run into U.S. T-bills, last resort. But interestingly enough, we actually sometimes see when the United States of America itself and growth itself has come into question, we often see that the market, out of absolute last resort, will actually run into the Japanese yen. So that's why I keep that on here. And I've often noticed historically that yen and gold often move very closely together. So I hope that helps sort of explain my thinking. I suppose the last sort of part of this equation is this crazy thing called Bitcoin. No doubt about it. I think everybody in crypto has definitely learned over the past couple of years that, especially with regard to things like altcoins, this is an incredibly speculative part of the market. This is the definition of venture capital. Millionaires are made overnight. Moon. People are thrown in the poorhouse overnight as speculative, high venture cap comes crashing back down to earth after the bubble pops. So, that alone should speak to where sort of crypto falls in this sort of risk on, risk off kind of world. I think to a certain degree, Bitcoin is sort of like the mothership, the flagship of this space. It might be interesting to actually at some point down the road actually have like a weighted crypto index that we could follow on this study. I do like to follow Bitcoin itself on this study, just as sort of, and to a certain degree, as a student of the market, I'm still sort of watching this develop and seeing where Bitcoin does fall in this spectrum. In a weird sort of way, it's almost like at some point down the road, maybe Bitcoin becomes absolutely integral to the world economy, and the economy can't function without it. So this always begs the question, what is the intrinsic value of one of these Bitcoins? What does it take to actually keep the network going? And it's, that's very similar to the conversation about oil. I believe oil bottomed at about $10 thereabouts back in the late 1990s, early 2000s, because in essence that was Saudi Arabia's cost of production, and they were the primary source of crude for sort of the international market, and I think to a certain degree they still are sort of the benchmark. A country like Canada could get really dangerous because we've gone and invested a ton of money, just billions and billions, mortgaged our future on the idea that oil prices will be $40, $50, $60 a barrel minimum. If we have to go back down to where sort of Saudi Arabia sort of sets the floor as sort of the main producer of crude, remember their cost of production, and I don't know what it is on inflation adjusted basis now, but it's probably $20 or something. So in a weird sort of way, crude oil, what's the cost of production to keep this thing actually supplied, and does the world actually need it? Stocks, we know that there's no intrinsic value to them whatsoever. It's just purely a proxy on future growth. And Bitcoin, to a certain degree, what is the cost of production for Bitcoins? That is the base of the market. So any kind of price action up here, ironically enough, whether it be the crude, whether it be stocks, whether it be Bitcoin, most of this price action is not the cost of production. It is not the intrinsic value of what these things are. This is just purely a speculation on, is there further buyers down the road that want to pay higher prices? So assets that technically have intrinsic value, and that things like bonds, principals guaranteed. Japanese yen, there's not likely to be a massive run on the yen because Japanese are the ones that own their own debt. And gold, of course, it sits there, and I'm a lump of gold, I'm not going anywhere. Stocks, no principal guarantee whatsoever, just purely a proxy on future anticipated earnings streams. Oil, as a classic commodity, is it trading at the cost of production? Okay, if not, then it's purely a question of sort of supply and demand in the marketplace. There's little intrinsic value here on oil, up at $40, $50 a barrel, $56. And then, of course, Bitcoin, like I said just a moment ago, what is the cost of production? And at $8,600, if that's what this print is here, I guess this was the CME close. We're up at about 9,000 right now. Are we anywhere near the cost of production? I think we're still substantially higher than that. So as a result, if any sort of fear of future growth, future demand comes in, the price could fall relatively easily. Okay, so I hope that sort of helps that risk on, risk off kind of thinking. And what I like to do is just sort of simply on a daily basis, what is the tone of the market? What is what's the sentiment in this space right now? we don't really say in the market that you really need to pay attention to price action. Unfortunately, with Bitcoin, it's a heck of a lot more. But on things like, stocks and gold and bonds and yen and oil, until we see like about a 2 or 3% move, that's usually a pretty dramatic move that catches market participants. A lot of times it's just sort of back and forth. But when I make reference to this on a daily basis, what I want to do is I want to ask, what are the trends? Do we have any structural signals coming in on these proxies? And then, on a day-to-day basis, if we see one particular sector is up and, a couple of the components in one of the other sectors are down, but one of the components is up, we might look at this and go, that looks a little suspicious. So I hope that helps explain that risk on, risk off. Peter says in the hangout here, what does Peter say? To determine risk on or off every day, in my opinion, is one of the important things to do as a trader. Okay, well, that's a good idea. On top of just sort of that day-to-day, though, I think it's important to, if you can, sort of zoom out and sort of see the forest through the trees. What is sort of that general trend? And, you guys have been hearing me on these, public broadcasts. I've been talking about wanting to get short risk off for quite a while. I was only able to get one of my ideal risk off short proxies on, and it's, the book trade is on the books. And that trade seems to be working pretty nicely. So on balance, you can definitely see risk off, that sort of, panic in the marketplace has come off dramatically of late. It is interesting to see how gold is trying to buck that overall trend. And we'll see what happens here. I got to tell you, the way the bonds are pointing and the way that yen is pointing here, I wouldn't be surprised if gold has to play a bit of catch up here. But nonetheless, we'll see what happens. Only time will tell. I thought it was really cool on our Thursday baby powder report. My partner on the site, the three of us, Sior, Julian, and I run the site. In his report, he said he was going to be fading this gold rally. We were sort of talking midweek. Hey, are you thinking uppy? Should we be getting gold bullish? And he's like, I'm going to totally hit this damn thing if we get up to 1510 to 1520 area. And so far, he's looking like an absolute genius. So way to go, Julian. Okay, so nice little dovetail. Let's head on over to crypto now. And let's talk a little bit about what the heck's going on here. And, I do find this interesting because, sort of my longer term cycle thesis, I've been thinking, not longer term, let's say midterm, I've been thinking that we're going through a down cycle here coming out of this sort of peak pivot. We got a big dump in stocks, and then we rallied right back up to the top end of the range. And we're actually getting to the point where this down cycle actually it may be coming to a conclusion here. And we actually have to get ready for an up cycle. And it wouldn't surprise me, everybody. Octobers are usually historically really nasty. But once we get through October and we actually get into November, historically, actually, a lot of these, seasonal relationships start turning up. So be prepared, people. We might actually, if we can sneak through the rest of October here and get into November, we might be setting the base for a pretty substantial rally. But that's still a couple weeks away. But so, thinking that sort of risk on, risk off kind of conversation, are we getting any sort of tells that, maybe we're heading back into risk on? Seriously. Well, as we said, yen, bonds, they've rolled over hard here. I don't know what the gold is up to, but it could very easily be, join these guys. The oil, of course, is bottomed, and I've been talking lots recently about oil stocks moving up. Some of the stocks look just stunning. A lot of our Russell 2000 names are actually starting to perform, and some of the mid-tier names are starting to perform. And lo and behold, holy crap, Bitcoin just came out of the woodwork. Boom! um, I think it's probably important to sort of preface, this conversation with sort of like, how do we say this? This is, I guess, I think probably sort of more of that fundamental kind of conversation about Bitcoin. And actually, I reached out to the gentleman who put this report together, and a lot of people on the net have been giving him high fives and praises and stuff. And I like to follow along. He's got some really interesting posts. This Phil B gentleman. And I reached out to him. And I said, a lot of people on the site really, really like this study. And I've tried to replicate your work as best as I could. But would you be interested in coming on the site and talking to our community and sort of explaining the madness and how they can build this study and what are you looking for out of this study? Remember, Brian's not here trying to say that, hey, just listen to Brian and whatever he thinks that's the way to go. I mean, that's not how I operate. I'm the type of guy, I want to try and do more of what works and less of what doesn't. And if somebody out there has got a good study and it works, hey, I'm all ears. And I was exceedingly pleased to see that this gentleman was like, yeah, I'd love to come on. So we're going to try for the daily brief. I think he said and I don't know whether I should show you these messages and stuff. Probably not. But anyway, he said he'd be interested after November 1st. So we're thinking maybe we're going to try and bring this gentleman on to the daily brief. And these are the kind of things that I like to do, sort of value added for our site and stuff. Is interview notable people on Twitter and stuff that have really cool ideas. So keep your eyes open, TRIers. For November 1st, we're going to have this gentleman on through a daily brief special to really articulate how he uses this study. And maybe, give you a couple pointers on how you can build it yourself. I mean, I like the idea that we're basically bounded between this lower band, yellow, green, whatever it is. I'm colorblind, remember. And this purple band up top here. And this is what I'm a little interested in this. Obviously with crypto, you go from one exchange to another exchange and back and forth, and levels are all over the place. Welcome to crypto. So your site might be different than these levels. I actually did, and I was pretty darn impressed, but I actually heard from some site people that on their exchanges, this Mountain Man level was traded to, and they actually bought this Mountain Man level. So some people actually on the site actually even were so slick that, they had in their plans that they just buy Mountain. And I guess on their particular exchange it was hit, and they, they were very, very happy when I talked to them yesterday. But on balance, when I look at this study, I basically, I have to say that, really top end of the range looks to be about 12,800, and bottom end of the range now appears to be around 6,300, 6,400. You can clearly see, and you've probably listened to Brian yammer on year after year after year about reload zones. So you can kind of see where Brian would be interested in hunting trade location. And all you level oneers, right, this is exactly what you just did. You got to get good at this. You have to put these reload zones on every single chart that you see and just keep hunting. Actually, a really good example, the Duke of Albuquerque was really interested in in this Syscoin, and I was showing the level oneers this morning that I saw Kevin's W big breakout, boom, And I didn't really want to chase it. I was thinking about, okay, how do I want to get in on this? And I just used this reload zone and just said, look at, I'm not exactly sure where the bottom is going to come in here, but I really do like the idea of just getting long here and risking against the bottom. So I just threw in a bunch of bids, and you can see 2 of 3 of my bids have been filled here just using this reload zone concept for trade location. So, that's the same logic that you see on this chart. I do like the idea that, basically this curve, and again, we'll have Mr. Phil B define how we actually, what the math is behind this curve. I wouldn't mind having some sort of scientific formula to actually come up with the actual numbers of this curve. But you can see doink, 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 doink. Can we get another doink here? Seems perfectly realistic. I certainly don't think it's unrealistic. And for the time being, also too on the upside, doink against the purple lines, doink, 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 doink. Could we get another doink up here? Sure. And I think I'd sort of made reference to this earlier, not earlier, but recently in these videos, that kind of thought that, for investors, this is a horrible trade location. Just, oh my goodness, everybody just getting absolutely ripped apart. Actually, to be honest with you, I was fully expecting these moving averages to roll over bearish, but this rally here, you could see. And this is one reason why I love Brian's crazy moving averages and not following things like everybody in the public follows, the death cross, the 50-day and 200-day moving averages. Wow, everybody was talking about death cross there. And the interesting thing is you follow Brian's crazy moving averages and they never actually turn bearish here. So I find that fascinating, but that's, it's here nor there. I definitely thought that these moving averages would represent resistance up here. And that's clearly not the case. Market has just blown right through them. I also made reference to recently that if I was an institution and I wanted to sell, ironically enough, I'm not allowed to just go and hit the bid because, if I go hit you saw what happened. What was this candle? This candle was $1.24 billion worth of Bitcoin. Somebody hit the bid and look at what it did to price. Boom! So what they actually have to do if they want to get short off of these levels is they actually have to engineer some sort of counter trend rally. Get all the crypto kids all super excited, bullish, rah, 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 moon, moon, moon. And so on that rally, they actually get their sell orders filled as everybody's buying into their sell orders. So I think to a certain degree that might be going on here as well. What's the fundamental driver out of all of this? And in the sort of daily brief recap videos and stuff, I was talking about this. What does actually like a fundamental shift actually look like in a marketplace? I would ideally like to see, the rubber hit the road. I'd like to see actual implementation. So somebody posted a really cool video in the lounge this morning of somebody's building out a blockchain where you can actually have an operating system off of the blockchain, which I thought was incredible. So that was, and again, this 1 + 1 = 3 about the TRI site is, Brian's doing his trading, you can follow along, but, we have people like this, Alim here. This is a fascinating conversation. It's just a quick introduction, young guy, he's full of piss and vinegar. What they're trying to do is create like an operating system that operates off the blockchain, which I thought was just so cool, and it just goes to show, is this, it's going to be developments like this that take us to that sort of the next stage where we've forgotten about BitConnects and, the SEC has done its thing and pooped on a lot of these ICO pumps and cleaned up the space. Poor old Merriweather people, they're all, washed out. And here comes the next generation of this technology. I don't know. On TRI, we're constantly talking about these kind of ideas. What is the next generation of this technology going to look like? And, if we actually, I did see that there was a reference that new laws are actually going into effect in China in January 2020. So I find that interesting. Mr. Zuckerberg himself even said, look at, if the United States doesn't get in front of this, they could be left behind. You better be careful here. I mean, I know and this is sort of almost getting into empires clashing. And I do believe to a certain degree, and actually listening to some of the rhetoric from some of the U.S. politicians, now their egos are starting to get in question here. When they were sort of talking to Zuckerberg, some of the statements I heard from them are, look, at the United States is the world's reserve currency and we dominate, and we don't have to put boots on the ground, as they said, because we can use our currency to impose economic sanctions and impose our will. Are you, Mr. Zuckerberg, actually suggesting that we relinquish that incredible power that we have over the world by moving away from U.S. dollar hegemony, that kind of thing? I mean, we're now starting to, and the politicians were even saying, careful, Mr. Zuckerberg, you're treading on very dangerous ground here. So to a certain degree, I think a lot of, and especially sort of the Democrat leaning politicians in the States, the impression that I'm getting is that they're looking backwards, not forwards. And I thought the message from Mr. Zuckerberg was like, you do what you have to do here, but just understand, if the United States doesn't get in front of this technology, somebody else will. And I thought it was fascinating. Literally the next day, Mr. Z comes out and says China's going to own this blockchain space. So, it's never a dull moment in this crazy world. I'll tell you that much, by crackers. And, it's this kind of catalyst that might sort of shake things up. Now, I don't know whether it's going to have any follow through here or not, right? I think it was a one-day event. And boom, it happened. Usually what ends up happening with these kind of moves is they don't actually come in just one wave. They're like that harmonic, AB equals CD kind of thinking. So that's, at the moment, that's kind of what I'm thinking I'm sort of seeing here. We'll go down to this is a 4-hour chart on Coinbase. And, full disclosure, for whatever it's worth, we did have things like short setups working on the moves lower, and they all got told to politely exit at scratch on the shorts, which I think, if anything, I'm pretty happy with the way these algo signals and bot signals just basically told us to just walk away. And I do find it interesting. People say, well, I don't really have a chance to walk away at scratch. Well, that's bullshit. Because on this candle, this was sort of the start of that counter trend rally. There is the scratch levels. And price actually behaved pretty rationally through this level. It came up right up against these levels. And the entry level on this bot, for instance, it was politely tagged. And you would have had more than enough opportunity just to walk away. It wasn't that big of a deal. And price didn't really get going like crazy nutso until we got up into here. But anybody who was short, if you were following trading models, this algo signal, it was told to walk away at scratch. Then the bot signal was told to walk away at scratch. So I think on balance, the trade setups actually operated efficiently. Like lower time frame day traders, they were actually told there was the last one on the short side was right here on this event, and it produced the day trader, it produced a loss, but at this point the 1 hours turned back up, and so basically at that point everybody was on hold right there from the shorting perspective. What's really cool about this model is you can see the dailies cross back bullish. The 4 hours were bullish. We just got a 1 hour bullish signal right here, and that was on the 26th. So that meant now the long side of this day trader model was active, and away it goes. Now it's hunting long setups, just doing its thing. And actually, I was kind of interested after this blow off top. You want to just sort of let the dust settle a little bit. And there was that 1 hour signal. First signal was a fail. Then win. And it just fired another big ass fractal right here. And it's just sort of treading water right now. So I do find it really cool how the day trader models have now all flipped back to the long side. And so we're just going to track and see what happens here. And then, as I said just a moment ago, what should happen here, as I said a few minutes ago, is usually what ends up happening is the market doesn't really move in one direction indefinitely. And you think about it, if the market wants to move up into here, once we get up to here, think of the rubber band. The rubber band gets so stretched in one direction and everybody's on the long side, nobody's short. How can the market go higher? There's no more buyers. So the market actually has to go through the process of starting to bring some sellers in, maybe people who are taking profits off of their buys off of the bottom. Maybe even some people's, like good old Mountain Man, actually start shorting here, which sort of balances things out. So this is sort of that balancing out process. And gee whiz, I don't know, has anybody ever heard me talk about... If I wanted to know whether this was actually still a bull or whether it was going to roll over and be a bear, is there some sort of fib level that we should keep in mind to kind of watch? Anyone? I don't know. Maybe yes, maybe no. Maybe hot, maybe low. Everybody gets high, everybody gets low. Nope. Good try, Colleen. Barbecue, there you go. Peter, 38.2, right? It's our first stop target. So if this is a natural move, we probably should see the market come back to the 38.2. Good answer there, Juan. Good answer, Andre. Good answer, Andrew. Hello, Sonny. Good answer, Bogdan. So we should probably ask, can we get a 38.2 retrace and then listen to the market? What does the market want to do? So we'll put on 38.2 and let's see where that lines up. Oh, gee whiz. So right back down into here. We could even make the argument that this might have been a full 50% retracement. And I think I have that chart on here, but that's another conversation. I don't know whether we have time for that today. But holy moly, is that ever freaky. Where did I put that? Oh, maybe I got rid of it. Oh, you know what? Anyway, oh well. Oh yeah, it's this chart. Silly Brian. Check out these 50% retracement hits. This is ridiculous. So I actually started this study, and I'm going way off topic here. Sorry, everyone, but I'm just having fun. I did this study, and I simply asked, okay, is there any logic behind what's going on here in price action? And because Bitcoin is very algorithmic, it is like computer-based, I kind of think that Mr. Gann really has relevance here. I'm not quite sure where the best sort of fib level to start this study from. I mean, maybe it should be from off of that low. I'm not exactly sure. But what I noticed was when you notice the breakout, and I guess this study I started it here. It's not really the best, but big run up in Bitcoin price. And of course, everybody knows this study. This is where things get really weird. 50% off of that monster move should have brought us back to 10,000, right? 20,000 just divided by 2. That's pretty straightforward. We came all the way down here to like 3,000. That move happened in about a year. So about a half a year, we should have seen 50% of that down move taken back. And that's basically what this event is here. Then wherever the end of this move is, it just so happened to go all the way here. But if we're following this sort of Gann timetable of 50%, 50%, 50%, then interesting enough, this high here back to this low we should see the 50% level hit by this date here. Well, it turns out that she had to hit it here. This is the original Gann sort of time frame, right? If we adjust these to what actually happened, it turns out that that was almost exactly 50% of that time. So then that means that by the end of this one, if we were on Gann's time schedule, then we should hit 50% of whatever this range is by the end of this window. And lo and behold, we're back on schedule. Isn't that incredible? I mean, when I saw this, I was just stunned. We got off schedule, and now we're back on schedule. So interestingly enough, I actually think Bitcoin's actually back on schedule. So if that's the case, then actually we should see whatever the ultimate high is here. The 50% level of this move here should be hit sometime around second week in November, somewhere in there. Hey, if this high, which happens to be this 50% level right on schedule here, if that high happens to hold, and you just don't know now, but if it does happen to hold, then that 9,000 level should be a pretty realistic target here. And then, whatever that low is, we should do a 50% level. But the point here is, if you're thinking about Mr. W.D. Gann and sort of the way that the sort of time price spectrum works, we're coming to something really big here. Everything is compressing down, compressing down, compressing down, compressing down. Get ready, folks. I mean, I think, but, it's just Brian's opinion, this thing resolves bull, but I don't know what's going to happen here. But the long and short of it is, according to Mr. Gann, something big is about to hit the fan here in probably the second or third week of December. Hey, speaking of which, speak of the devil. The sort of juxtaposition to this is there's supposed to be a really big planetary relationship shift happening in early January 2020. That's supposed to be one of these sort of longer term, sort of, generational shift cycles in the planets. So I don't know whether this is, foretelling. I will say one thing that I was actually pretty damn impressed with. And some of the major news wires. I can't find it, though. So if somebody watching can find it, there was somebody called Loopsis or something like Loopshi, who actually, publicly a while ago declared that October 24th was going to be Bitcoin's big turn. That's when the pivot, according to all his analysis and his study, said, and he's expecting just straight line up. Oh, look at that Benjamin, this guy's an all-star. He's already got the link here for it, so let's see if I can get that. Lupushi, am I pronouncing that right? Lupushi. So and as I said before, I'm not here to say, hey, I'm smarter than anybody else. I'm dumb as a fuck. But if I see that something works, I want to do more of what works and less of what doesn't. And if this guy knows the magic formula, okay, well, I'm going to listen. There was one that he had where he actually did all of the dates, and that was the one that I wanted to retweet out. This is interesting. I don't know whether these are this is his work or not. I did see a major newswire was quoting him, and he had this interesting tweet that showed about a half a dozen different dates. I think they were actually saying, you want to know who actually puts bottoms in Bitcoin price? It's these whales and their cheeky games. Now, I don't understand the logic behind the reasoning why this gentleman thinks the way that he does. But nonetheless, I'm another market participant. I'm listening. I'm all ears. So, I think we should be cognizant of the fact that that there are people, and there was another big whale out there that was coming out and saying, I'm going to be buying at $6,000, right? I like that level. I like a nice dip against this yellow line. The market will do any old damn thing it wants. I mean, if this is the ultimate bottom on Bitcoin, so be it. I don't personally subscribe to that newsletter, but, there are people that are coming out and basically publicly saying this is the lows. If you do subscribe to that newsletter, fine. But try and hunt setups. What are your reasons for acting? Do you trade mountain mans? Like I said, we had one gentleman that I was enjoying a really nice time over at Shane's, enjoying his birthday with, who said he went and grabbed that 61.8 fib tag on his particular market that he was watching, and he's long Bitcoin now. If that's your plan, then rock it, own it, do it. All I care is, try and have a logical process as to what is going to make you act in the marketplace, and try and follow that same logical process over and over and over. Rinse and repeat, rinse and repeat. All right. So I sort of said earlier, I was kind of thinking that markets never move in one direction forever, and I got off on this this crazy GAN tangent here. Sorry about that, everybody. But it's so fun when we get into this school program, and this is one of the reasons why I love running this school program, is every single quarter I'm forced to come back and revisit ideas and stuff. Regardless of what your thoughts about longer term Bitcoin, we can definitely say, and I was so pleased to see on the site, there were people on the site that actually hunted this little double bottom, and there was signs of divergence. We had an RSI study that we were working away with on the site. This RSI study, what happens when RSI gives you a second W through things like 50 lines. I think this is the model that we were using on the site. And great analogy, and I've been talking about this at length about the day trader model. Is it a good idea to build into your plan? And this is sort of a rhetorical question, but I think the answer is pretty obvious. But is it a good idea to try and incorporate in your plan some way to hold on to a little bit of your trade? Maybe your 2-to-1s have been hit, and try and hold on to a little bit of that trade, because maybe that trade turns into an absolute monster. So here's a great example: 2-to-1s. You take all your profits here. You're like, okay, well, I booked a win next bus in 10 minutes, and then you look back and you go, oh shit, look how much money I left on the table. If I just held on to a little bit of that short, would that have been a good idea? Maybe. So, this is that day trader sort of anecdote of that. Always a good idea to try and have in your plan some way to take partial profits at good solid levels, and then just see if you can maybe move your stop to scratch on the remaining. Maybe it's only a quarter of the position, maybe an eighth, right? Just some little part, because you just never know what the hell's going to happen on the other side. And I think this was a good example of that. So this was an example where we had trade location defined by a harmonic level. Now, I've changed the lines here because they didn't fit on the screen, but in essence, this is the same distance, right? You can go, bots would go AB, right? Something like that. And then CD. So this is the bastardized way of doing harmonics, right? PRZs. And I don't know whether I've drawn these numbers exactly correct. I just eyeballed them. But A, B, C, D. So the classic harmonic people, this is actually a potential trade location. Look, trade location. First reason for a trade. We have trade location. Then you look down at your indicators and you go, okay, well, do I have any sort of signs that this market is potentially stronger than what price is leading me to believe? And we look down, and in this particular case, we were walking people through how to use RSI and the concept of W's and W's through 50 lines to tell you that the market is actually quite bullish. And then, of course, last but not least, just like I showed you that Andrew chart right at the beginning of this video, in comes a beautiful W, and away we go. In this particular case, 2-to-1s were hit, and those people that took the 2-to-1 profit objective, if you know, in your plan, if that's what it is, take the book the win. Way to go! Next bus in 10 minutes. But you know, for those people that are moving on, and you know, I do like for our basic introduction education program just to get people into the habit of taking a profit, booking a win, psychologically seeing your account balance go up. Chung, 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 chung. That's a huge hurdle to get over a new people to trading. So right out of the gate, we sort of suggest to all new people, look at just get into the habit of taking full profits at 2-to-1. As we sort of work through our education program and people become more mature as traders, then we start including ideas like look to take partial profits at things like 2-to-1s, and then start trailing stops using market structure to keep you in the trade as long as possible. No reason why you couldn't have done that. And you know, trailing stops, I do remember on the site in particular when we saw this jump up here, I was like, well, you know, we're not getting any M's in RSI yet. In fact, actually RSI was really sloppy through all this, just kind of a funny move up. So I was like, you know, right through here, I was kind of like, well, let's see if we am out here. And those people that were trailing stops, this low obviously was a key pivot. I wouldn't have a problem if people started trailing against that low after moving their stops up from scratch. And as you can see here, this is very odd disconnect. The market launched higher again. So you could almost argue that this is almost like an AB equals CD. So boom, boom. Boom, boom. Take us up into this level. You can also see off of the previous range, I've drawn extension levels. All you current level oneers, this is what I want you to start thinking. You know, if I was looking for this market to, we've gone through the previous range, we've busted higher. If I was looking for resistance to come in on the market, where might that be? And in this particular case, of course, we went blasting through 200%, but notice we came right back down into the parking garage and just sort of settled down in here. Actually, I was really impressed. There's one gentleman on the site who actually, you know, he trades off of these hourly charts. And of course, again, that's a function of your trading plan. And he's kind of like, well, Brian, you know, I see off of the hourly charts, I see 1 kilo, 2 kilos, 3 kilos. What happens if I start like drawing bot levels off of this entire range? 33%, remember we said 38% probably ought to get hit. So we know that this thing's actually acting very normal. So, you know, again, I had made reference to this a few minutes ago. If you were thinking, you know, markets never move in a straight line. They often have to do that sort of, you know, first move up, then back up, reload, all that kind of talk, then get ready for the next launch. So, you know, if we think about this chart, that maybe this is an AB equals CD continuation pattern, where might that take us? And I'm thinking we could very easily work our way right back up into this original high up here. It's not out of the question. I think this is a really, really good illustration of, you know, I often talk to people in the public. I'm trying to get the chart lined up here. Sorry, everyone. I talk to people in the public about this guy that I used to trade with in the crude oil pits, Brandon, Mountain Man. And remember we had said earlier, somebody had a Mountain Man level off of their particular exchange that was here, and they just bought. You can see how a guy like Brandon makes money, because he'll hit this Mountain Man level and then on a return to the mean, and you might use something like even just like a short-term moving average. All right, let's say I'm going to use like, I In this case, this would probably be too fast for him. But, like typical day traders, they love to use like really fast moving averages, like say something like a 9-period moving average. And maybe we're not operating off of like a 4-hour, but maybe like a 1-hour. So a guy like Mountain, he'd hit this 61.8, and then he'd take profits on a return to the mean. And also, too, if we looked at the session profile, my hunch is this was probably nothing more than just a return back to value. This was a push up. My hunch is this was probably single ticks. Why don't we take a look at that and see what it looks like. All right, there is the move. Yeah, not bad. So you can see there is Mountain. He's sitting up here waiting to hit this. Market blast up here. And in essence, he's going to hit that 61.8 and then a return back to the mean. Usually return back to the POC is in order. He'd be taking partial profits here. Move his stop to scratch on the remaining, and who knows what the hell's going to happen. In this particular case, he'd still be a little bit short from his level up here. He's already taken some profits at sort of a return to the mean, whether it be moving averages or volume profile levels, things like POCs. And he just have the remaining position with his stop at scratch. He might get blown out, might not. It's a trader's life, And that's sort of that same sort of conversation that sometimes it's a good idea just to leave a little bit on the books. Move your stop to scratch and just see what the hell happens. So, that's sort of what I'm seeing out of the market right now. I can understand guys that are thinking sort of bigger time frame, AB equals CDs to take us that next leg higher. For a guy like me, though, I think this is a little bit too fast. I like the idea of watching this 4-hour chart for this setup because it's so big. That I'm inclined to see if I can let this formation here fill itself out a little bit more. And this is just Brian's opinion, right? You trade your trading plan. And I love this about TRI. We see lots of people coming in, different setups flying all over the place. Love it. There's a million different ways to skin this cat. There's no one right way. For me, when I look at this, I'm a little bit concerned that, if I look at the entire profile of this range, remember Mountain Man. So I think I don't know whether I told you guys stories about this on YouTube, but, all the site people know this. Usually what would end up happening in the pits with Brandon and I is I would see a move like this, and I'd be hunting my bot setup. And, of course, Mountain, he'd be on the other side of the trade. He's hit that offer. And we would be sitting there, and, I'm not going to be calling myself Bitcoin, but it's a nice B, so there's Brian. So we'd be sitting there in the crude pit, sitting there for half the day, and we just don't know who's going to win. Brandon's short from here, Brian's long from here. What's going to happen? If this thing does not bot out and it's not trend continuation, Brandon wins. If this thing bots out and trend continuation, Brian wins. And man, I can't tell you how many times we'd sit there in the crude pits and just simply Brandon short, Brian's long. Who knows who's going to win, but one of them's going to win. And quite often what would end up happening is, notice that happens to be right around that same level. Quite often we'd have situations where, let's say maybe the Mountain Man level came in here. We'd have the market move up to where I'd be at scratch. That usually would happen. And maybe Brandon wins and Brian gets stopped out at scratch. That would happen a lot. In this particular case, if move stop to scratch level is hit, then Brandon, he's totally gone from the trade. Brandon's already made a bit of money on that return to the mean conversation. But as I said just a moment ago, this isn't filled out enough for me to really have a lot of confidence that this is a serious low. And it's interesting. I've just eyeballed this, so I don't know if it's really accurate or not. But it is interesting to see how the bot level is sort of setting up against these candle body highs. It looks to me like there might even be a little bit of a gap down here. I don't know. Sans script isn't saying there's a gap, so maybe not. But, for me to actually hunt like a serious bot here, I'd like to see one low, two lows, three lows, and then let's rock and roll. So this still is a bit early for me. As I had said earlier, and I do find it interesting that the algo actually, or not algo, or I want to be a day trader, just simply hunting 2-to-1 setups and whatever the higher time frame trend direction is. It's actually got a long setup working right now. I don't know what's going to happen. Maybe this thing M's out and this thing gets busted out. Who knows? But, since last night's signal, it's running 4 winners, 1 loser. It's not bad numbers. Here, this is really a question about trade size, commission considerations, all that kind of stuff when dealing with mechs. I'm not touting this as a polished product. I'm just simply vetting this setup out and just seeing, we had just an absolutely remarkable track record there through the bear, right? And these are all the short setups based off of trade, the trending market down. And I mean, you can see a day trader is pretty damn busy. This is where we started this vetting this setup process out. And what do you think? Is there a bit of work involved in vetting a setup? A little bit. Interesting here. All of these are all short. And now the market has shifted to long, and now this thing goes into hunting longs. And, since that last signal, looks like Mr. Day Trader's pretty happy just hunting longs. So, it is what it is. And as I said there a few minutes ago, we did have some people on the site that were saying, I'm getting 1-hour setups coming in. And I think I just showed you there just a moment ago. I guess it wasn't this chart. But I showed you there just a moment ago that hourly chart on RSI. And I thought it was interesting. There are W's coming in here. Those you can make the argument. We like to follow trend line breakouts. We call it our LJ setup. Used to be called RJ. But we call it LJs now. And trend line breakouts look something along the lines of this. So you can see how the trend line's broken. All right, we got 1, 2, 3 tags. All right, give me a W on the other side. Hello, there's a big fat W. So you can make the argument some shorter, lower time frame LJs are coming in here now. And also, too, this is a cool demonstration of this sort of double RSI W kind of concept. So this is a check of the 50 level. You notice that we put in a little bit of a W right there on that check of the 50 level. We can do that. Holy jeez, it's already 12:30. I got to wind this up, guys. I got to get ready for Liam. And then we get another W. And we'll make this yellow. I think you can make the argument we're starting to get multiple W's coming in on RSIs. I'm not overly excited with this, but can you make the argument that we've got multiple W's putting a base in momentum here for you to justify taking this risk on this trade? It's there. As I said, for a guy like me, I'd like to see this fill out a little bit more. I'm going to be hunting this AB equals CD off of that 4-hour chart. But, at the very least, I suppose you could argue, bot-wise, it's there too. Live by the sword, die by the sword. Probably keep a real close eye if you are taking this kind of trade. Maybe watch this trend line really closely. If we start failing through this level, maybe don't be so married to the trade. But, she is pointing up here in the short term. And like I said, for the I want to be a day trader people, they're actually long right now. Go figure. So, all right. Hopefully that gives you a pretty good idea of what I'm seeing here on the corn right now. I've talked quite a bit here today, so I don't think there's much else I really want to add to the conversation. I will say one thing. There are a few altcoin names that I've been talking about that I think look interesting to actually start going in and hunting reasons to get long. And so this Syscoin, this was Kevin was really interested in this name. I was humming and hawing about how to get into this, but I actually did do some buying over the weekend, just working some stink bids in reload zones. So there's a really good example. It's actual, it's real time, it's happening, in our face application of that reload zone concept. So as you can see, I've got an average cost right in here, and I'll just simply risk to a break of these lows. And if it's broken, so what? Walk away, next bus in 10 minutes. If these lows hold, and this W does hold, what do you think? Is there any chance of making any money on this kind of asset? You tell me. Does this thing have any room to run up in price at all? Is it worth taking a risk when you look at a chart like that? Even if, let's say, wicks and tails like to be eaten. Look at the size of this price action. Let's say, hypothetically, we don't go to new highs. All we do is come up and tag that candle body high in here. Wicks and tails like to be eaten. Original market structure. M tops. Blah, 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 blah. Is there any kind of money to be made, risk-reward-wise, if I take a shot off of here, maybe look to try and sell half on a double and establish a free position? Is there any money to be made in taking this kind of risk in the marketplace here? The answer should be pretty straightforward. So hopefully you can understand why I don't mind taking risks down here. There's no guarantees that these bottoms are going to hold. None whatsoever. Get used to it. You're a risk taker in the marketplace. No guarantees at all. But is it worth taking this kind of risk for potentially this kind of insane reward? And this is basically what I did with that last crypto cycle. I mean, look how far you have to zoom out just to get back to that level, And there's a bunch of them right now. So, try and build your plan so that you can always stay in the game. Try and keep a little powder dry. You don't have to bet the farm on these, but just a few of these things performing can actually translate into some serious, serious capital. All right. I think I got to hop at that, guys. Like I said, I actually have to go get ready to give my boy an awesome afternoon. So have yourselves a good day. I hope some of the information that I've imparted to you today helps. If you have any questions, feel free to ask. And hopefully I've given a pretty good sales pitch as to why I think this community that we've built is so awesome. Because I tell you, man, it's definitely a 1 + 1 = 3 kind of place. All right, have yourselves a great day, everybody. All the best. And the only thing left for good old Uncle Brian to say at this point is a big bye for now.